Tuesday, November 2nd, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the bond market, specifically the government bond market, even though all bond markets are very important. And I think the government bond market is at a turning point. We're actually starting to see the market itself challenge the central banks. Most people think that if the central banks want to keep their target rates near zero or even negative or very close to zero, that all other interest rates are going to stay low. And that has been partly true. And by other interest rates, I mean the rates along the maturity spectrum. In a bond market, you have all kinds of maturity, mainly because if you borrow or lend money, because that's what a bond is, and it's a securitized loan, of course. So if you borrow or lend money for a month, the interest rates is gonna be less than if you did it for a year, 2, 3, or 4, because of the time risk. Yes, there are times when the yield curve inverts and it costs more to borrow in the short term than in the long term. But normally what we see is an upward sloping yield curve. And the central banks have been able for, I would say, 13, 14 years to keep the whole yield curve under control, except, of course, during the European sovereign debt crisis, the government bond crisis in 2011, 2012, where we saw the ECB lose control of longer term rates, when we saw Italian bond yields go from 3 to 7%, when we saw Spanish, Portuguese, Greek, and Irish yields go to double digits. And there was a crisis, and it could have spread worldwide. But the ECB still had some ammunition. The inflationary situation in terms of the RPI and consumer price index and commodities wasn't as bad. So Mario Draghi, who's now the prime minister of Italy, unelected, by the way, he was the head of the ECB at the time. He said he would do anything it takes to keep those bond markets or those countries from going bust, because that's what happens when interest rates or yields spike like that and the central bank loses control. The governments can't service the debt anymore. And we've seen that the debt has ballooned in the last 18 months everywhere around the world. But now it seems like the transitory language is not convincing the bond market. And the bond market has been pretty much tamed. And there used to be a term called the Bond Vigilante. They were always the people that put a spotlight on governments that were spending too much by attacking the bond market, by selling bonds and making yields rise to control government spending. They were successful up until like early mid-90s. They were still around, the Bond Vigilantes, but they've been asleep for 30 years. There has been speculation in the last few years that they've been waking up, and I think it's possible that they are right now. And this week is particularly important because if you look at the bond market, it's the biggest market in the world, even bigger than the stock market. And if you think of it as a pyramid, at the top of the pyramid are U.S. Treasuries, the U.S. government bond market. It is the benchmark for every other bond market, not only government bond market, but corporate bond markets. junk bond markets, municipal bond markets, every kind of market, and even the stock market. I would argue the everything bubble has been possible because yields have remained so artificially low because the central banks have manipulated it lower with a lot of propaganda, I would say, a lot of QE, of course, creating reserves out of thin air to keep buying those bonds, a lot of manipulation of the value of real money, i.e. gold and silver. So what we're seeing now is some cracks below, even at the top of the pyramid, but we're seeing some big cracks below in the periphery in countries like Australia, Canada, even Italy now. There's been a bond market sell-off in the last couple of trading days. Today, the RBA met and they've announced that they've given up on trying to maintain yield curve control at 0.1. They lost control of that. The RBA chief is saying it's because the economy has improved, so they don't need it anymore. So how come 2 weeks ago they still needed it? Has the economy improved so quickly? So apart from the RBA meeting today, we've got the meeting of the Fed starting today and continuing till tomorrow. And tomorrow there will be the announcement, the press conference. And it is expected that the Fed will announce tapering. And all tapering is decreasing the amount of QE that they do, and that they should stop doing QE by the middle of next year. But the other important thing that the markets are looking for is for some guidance on whether the Federal Reserve is going to be as aggressive as the market is discounting. There's a lot of derivatives out there in the financial markets that bet on short-term interest rates by the central banks. And they're betting that the central banks are going to have to tighten a lot quicker. So the forward guidance or any comment from the FOMC about that is going to be very important. It looks like in Europe the same thing is happening. The markets, the derivatives market that trade these instruments, they're pointing to a lot more rate hikes than, for example, Christine Lagarde, the president of the ECB, is pointing towards. So there's like a conflict now between the markets. They want to, they're starting to think, wow, this inflation, the prices, it's not transitory, it's not improving. In the US, you've had 5 consecutive months of CPI prints over 5%. That's not transitory, and it could get even worse. The supply chain problems, the shortage problems, commodity prices, there's still a lot of trouble. So yes, the bond vigilantes could be waking up. And why are bond prices and yields so important to everything else? And I would say it's so important to this whole everything bubble. Well, because it's the price of credit, or if you want to call it money. And that's the 10-year yield, for example, in the US is the what they call the risk-free rate of return. And a lot of other investments, their cash flows are discounted with these very low rates. And if rates start rising, well, it's going to hurt everything. It's going to hurt governments because their bills for interest payments are going to go higher. They're going to have to either borrow more to pay that or tax more. It's going to hurt consumers because of consumer credit, mortgages. It's going to hurt local governments. It's going to hurt corporations. A lot of corporations have been borrowing because it's been so cheap to buy back their stock or do anything else. So I personally think that would be a good thing because we've had 40 years of this financialization of the economy. And I think this would be a sea change. And there's an article here in the FT this morning about the bond market. And the title is Bond Traders Ramp Up Bets on Big Shift in Global Monetary Policy. Investors test central bankers' insistence that elevated inflation will be fleeting or transitory. And I thought this was an interesting comment here. It's from Deutsche Bank's Global Head of Currency Research. Yes, douche bank, if you want to call it, Deutsche Bank. That bank that never seems to die, the zombie bank. So here's the interesting comment that I thought he made here. It says, Saravellos likened the recent wave of attacks on central bank guidance to the end of the Bretton Woods monetary system in the early 1970s. Yes, how did the Bretton Woods system end? Well, the central bankers lost control of the gold price. The London gold pool unraveled. The London gold pool, which I've spoken about before, was an overt official program by the major Western central banks from US, Canada, Europe, Japan, Australia to keep the gold price fixed or at $35 an ounce, keep it from rising because there was a lot of inflation. And in 1968, it unraveled because they couldn't keep, there's too much gold flowing out and inflation was starting to pick up and it just unraveled. And I thought that was an interesting comparison. So you can see what would happen to gold and silver. So you can see how important it is that if the current bond market bubble unravels, much like the Bretton Woods monetary system did, and they're both on the back of inflation, you can't keep inflating forever. Investors will want to get paid in real money. So I will be keeping a close eye on the government bond markets. That's the market that I followed for over 20 years. In my career in finance, I was a government bond broker, not only the cash market or spot market, but also futures and options or derivatives. And I can tell you that I've noticed there's been some sharp moves higher, like we've seen in Australia, Canada, even the UK, and Italy. But they're still under control of these markets, the central banks. But there are cracks, as I said. Even the FT, another article that just came out a few hours ago, U.S. bond tumult risks triggering stock market volatility, analysts warn. Gap between equity and fixed income volatility measures widens at fastest pace in a decade, according to Bank of America. So what's happening here is that the bond markets are getting more volatile, and bond markets are at the base of the stock market. So the fact that stock market volatility is still very low means that we could start seeing trouble in the stock market, or maybe we are all wrong, or I'm wrong, and the Bond Vigilantes are wrong, and inflation is going to go dormant, it's going to go negative, like some people think, which is something I've never seen. Negative, I haven't seen negative CPI ever, especially here in the UK. So I think we could also see volatility in the stock market pick up. That usually means a stock market under pressure. And yes, I know we're making all-time highs every day, and it seems crazy, right? But yes, with that, let's look at where the markets are this morning. It's about 10 to 9 a.m. London time. We got spot gold, $17.94. It's up just over $1. Range has been $17.89 to $17.97. Silver is down 7 cents, trading at $23.96. Range has been $23.90 to $24.09. So pretty narrow range overnight for the precious metals. The Dow futures down 17 points, NASDAQ down 20, S&P down 3. So fairly quiet. FTSE 100 index is down 50 points, 0.2%. To the currencies, sterling is down 0.1% at 136.46. The euro is down 0.1 at 115.94. Dollar is down 0.3% versus the Japanese yen at 113.63. The dollar is unchanged versus the yuan at 639.40. Aussie dollar is down 0.75% at 74.68. The dollar is up 0.25% versus the Canadian dollar, 123.97. And the Kiwi dollar is down 0.25 as well at 71.67. Interesting that the Aussie dollar is down almost 1%, even though the decision by the RBA today was more of a tightening decision. But I think what it shows is that maybe foreign investors are losing a little bit of confidence in the Australian Central Bank. Who knows? To the commodities, WTI crude is up 0.25% at 83.50. High-grade copper is down 1% at 4.32. And natural gas is up 2.5% at 5.32. So just before we wrap up, a quick look at the US 10-year yield, which is the benchmark for the whole world. It still seems to be under control. We're around 1.56%. I think right now the Federal Reserve wants to keep it between 1.3, 1.7. But anything could happen this week. I think there's a lot at stake for the central bankers, their credibility especially. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.